Welcome back to a special edition of The Close, live from Doubleline's headquarters in Los Angeles. We're going to talk mortgages. We're going to talk the housing market with the average rate for a 30-year fixed mortgage creeping back up, now around 6.37% in the most recent week. Now, it's an elevation in borrowing costs that's been going on for a while, and it has the U.S. housing market in a bit of a standoff. But is it possible, potentially, that paralysis is also creating one of the stronger credit backdrops in residential mortgage bonds in years? Our next guest, he runs those numbers, I presume, every day. Ken Shinoda joins us here. He's portfolio manager here at Doubleline, where he oversees the firm's non-agency residential mortgage-backed team. Great to see you, Ken.
Thanks for having me.
Let's talk about where interest rates have gone, where they potentially might go, and the idea of whether kind of this long-term era of outperformance by agency MBS is indeed kind of behind us.
Well, agency MBS actually had a rough spot as rates rose starting in around 2021. It went through one of the worst periods of relative performance to corporate bonds and treasuries that we've seen in a very long time, because we basically took all the buyers and we took them out of the market. The Fed was gone, money managers were seeing outflows, the banks were seeing deposit flight. And we saw at one point 200 basis points annualized underperformance relative to corporates over 5 years. I mean, that's hard to do in fixed income, right? But from there, from the highs in rates, mortgages have done well. And we think it's a very interesting place for investors to look at, given the fact that the corporate credit markets, with so much CapEx for tech, we think are going to become more correlated with equities. So here's somewhere you can pick up spread over treasuries and have a very low correlation to that tech.
That's an interesting thing, because we've talked a lot on the show about sort of the sort of meshing of correlations with what was once supposed to be the diversifier. You don't hear as many people talking about MBS in that way, or at least you hadn't until recently. And I'm curious as to whether that actually sticks. Is this sort of a short-term cycle of this, or are you willing to bet that this is a long-term structural trend?
Well, really what happened was that duration assets, so like treasuries, didn't really work because inflation was elevated, right? When you get CPI kind of over 3%, stocks and bonds start behaving kind of more correlated to each other. And so we went through a period in 22 when stocks went down, treasuries went down, MBS went down, everything went down, right? In normal times, when you have kind of more normalized inflation, usually treasuries and agency mortgages have that kind of protective quality where when you see risk off in equity markets, it's really the credit markets that see the hit to them.
And I want to ask sort of a long-term wild card. You know, you think about the potential privatization of Fannie Mae and Freddie Mac. It seems like the noise has died down a little bit, some of that momentum that we saw maybe at the end of last year. But you think about the non-agency market. How would that potentially factor in? What effect would that have if we were to ever see it happen?
Well, Fannie and Freddie's footprint has grown since post-GFC, and it's taken some of the loans that would otherwise go into the non-agency market, go into Fannie, Freddie, Ginnie Mae type bonds. So that would actually make the credit markets of the mortgage market bigger. So you'd start seeing origination happen that is now going to Fannie, Freddie. It might push rates up actually for borrowers, and I'm not sure the administration really wants that.
Interesting. Do you think it actually is ever going to happen? Do you think we get it done before 2027, 2028?
So I think they talk so much about affordability. I think you would need rates to fall pretty dramatically for them to be able to pull it off, because all else equal, privatization or them becoming public companies probably makes mortgage rates go up a little bit, and I just don't think that's good going into the midterm elections.
Are investors, though, right now in the mortgage market, whether it's agency or not, are they looking for shorter duration now? I mean, because obviously, you know, at least with the stuff coming out of Fannie Freddie, I mean, you're locked in more or less, or at least you have that negative convexity if for some reason you are looking to get out. Are they looking for shorter duration?
It's both. I mean, banks like shorter duration. It matches their liabilities. They've been enjoying buying floating rate securities. And then there's life insurance companies that need that long duration. I mean, one of the reasons corporate bonds have done so well is there's pensions and life insurance companies that just need that duration, and corporate bond spreads, while they're tight, where else are you going to get that spread over treasuries and kind of that safety?
I am curious about the difference that you're seeing right now between what's going on in the residential housing market relative to what we're seeing in commercial real estate. It seems like I don't know if it's a divergence, if that's the best way to describe it, but give me a sense of how you see it.
So coming out of COVID, the housing market was kind of an enigma. People thought, okay, you know, it's going to get crushed, and it turns out everyone wanted to buy homes and, you know, go huddle up in them and hide away from their friends. And then rates rose, and people thought, well, this is going to cause housing to go down, and it didn't go down largely because of supply. Housing is all about supply demand. Going into the GFC, we had too much supply. As rates rose, it's really the supply constraint that held housing up. And it was a tale of two cities, with housing doing well, commercial real estate doing poorly, peak to trough decline, 20–30%, depending on the subsector of commercial real estate. I feel like it's flipped, right? Housing did so well for a while. You're starting to see housing go sideways. Some cities actually going down in price. But commercial real estate, the poor people in that industry, they've seen so much rough times with rates rising and COVID. Finally, it seems like that market's healing. It's bottomed. You're starting to see light at the end of the tunnel. And with the debt markets kind of opened up, we see a bottom in commercial real estate and kind of good times ahead.
That's really interesting. Talk to us about how office fits into that picture when it comes to commercial real estate. Because, I mean, in the pandemic, coming out of the pandemic, it was always, commercial real estate ex office. It was hard for that to sort of shake off that stench, if you want to call it that. How are you thinking about office right now, and how regional is that market?
It's very regional, and office is about roughly 20% of the commercial real estate market. So it's one of the subsectors that's not doing so great, but it's building by building, region by region, city by city. I mean, we're in downtown LA. We can look across the street, probably half vacant building there. You go down to Century City, it's fully occupied. Yeah. Everyone wants to be there. It's clean. There's no homeless people. And so those properties are in high demand. Very low vacancy. You come to downtown, it's a very different story. And we're without traffic. We're about 20 minutes away. With traffic, it's your guess how long it'll take you to get there.
I'm sorry, is there something called without traffic in LA? Because we just came over from Century City. So
yeah, and I will say there was so much construction. I mean, even at the hotel I was at, it was hard to get a cup of coffee because you had to navigate all these different construction vehicles. But, when you talk about office especially, and you say it's city by city, how much do local politics factor in? I mean, how much are you taking that into consideration when you're, evaluating different spaces?
It's a big thing. I know a lot of friends that have small businesses or medium-sized businesses that were in downtown LA, and they're moving to El Segundo because they don't have to pay as much gross receipts tax. So I think politics has a lot to do with it, and California is not that business friendly, and downtown LA is not that business friendly. And there's a new election coming up, and we'll see how things go. But change, I think, would be good for the city. Spencer
Pratt, he's been crushing it on social media.
I've heard of him, right? Yeah. He's doing well. I do want to. We only have a couple minutes left, but I do want to talk a little bit about. You recently made a comment about how 2026 is kind of the year of carry. And I want you to just kind of encapsulate for me, A, what that means, but more importantly, where the opportunity is in that right now.
Yeah, I mean, it just seems hard for interest rates to fall in this environment with what's going on in the Middle East and energy prices elevated. You look at inflation break-evens, which are the market's expectations of future inflations. Those are starting to creep up. So unless there's a big growth scare, which doesn't seem like that's imminent if you look at earnings, it's hard to see bonds fall in yield. So that means you're just kind of going to clip your interest carry or your coupon on your bonds. And the front end of the curve has risen a lot. So with the 2-year at 4%, buy some credit assets that have about 100, 120 basis points over that. It's 5+% return. It's pretty good.
Yeah.
All right, Ken, unfortunately we have to leave it there. But let me just say, it is so great to see you in person. Usually we talk to you post-Fed. It's over Zoom. It's very different. So really nice to see you in person.
Absolutely. Thanks for coming to our offices.
Thank you for having us.
That is Ken Shinoda. He oversees Doubleline's non-agency residential mortgage-backed securities team. And coming up, special coverage from Doubleline continues with Jeffrey Sherman, Robert Cohen, and Jeffrey Gunlock himself still to come.